Good morning, everyone. We are starting now the second day of the conference. I hope that you had a great first day and an enjoyable evening and a good dinner. So in this session, we will focus on banks and specifically on the relationship between banks and climate risk. We are going to have 3 very interesting papers and a discussion. The first paper will be presented by Caterina, that she is not here with us, but she will present online. And in this paper, the authors study whether banks' environmental disclosure reflect their lending policies. The second paper will be presented by Hyeyoon. I hope I pronounced it properly. And in this paper, the authors evaluate banks' exposure to transition risk. Then the third paper will be presented by Miguel. And here they provide evidence of a climate risk-taking channel in a bank's lending policy. Finally, there will be a discussion by Roberta Fiori. Just a few words about the presenters. Caterina is the senior team lead economist in the Financial Research Division of the Directorate General Research of the European Central Bank. She previously worked as an economist at the Bank of Portugal and the Bank of Canada. Hyeyoon is a financial research economist at the Federal Reserve Bank of New York, and prior to graduate school, she worked at JP Morgan. Miguel is head of the Money, Credit and Financial Account section in the Directorate General Monetary Policy of the ECB. Prior to joining the ECB, he worked at the Bank of Portugal. Roberta Fiori is Deputy Head of Financial Supervision and Regulation Directorate General at the Bank of Italy. Then let's start with the paper, with the presentation. The first paper is entitled Glossy Green Banks, the disconnect between environmental disclosure of lending activities, and they will be presented again by Caterina.
I'm here. Good morning, everyone.
Okay. Caterina, the floor is now yours.
Yeah, so apologies for not being there with you in beautiful Venice, but thank you very much for still keeping the paper on the program. This is a joint work with Mariassunta, Giannetti, Martina, Jasova, and Maria Loumioti, and the usual disclaimer applies. Now, let me try. It works. Okay. So over the past year, we have seen banks increasingly emphasize their environmental activities in their investors' reports and voluntary disclosures. We know from the corporate finance literature that there are many banks.
Sorry, are you sharing your slide?
Oh, yeah, it's not working. Okay, let me try again then.
We're not seeing any slide.
Okay.
Okay, great. It went.
Is it working now?
Yes, thanks.
Okay, perfect. So, as I was saying, banks have been increasingly emphasizing their environmental activities in their investors' report and voluntary disclosures. Now, we know from the corporate finance literature that there are many benefits about disclosing, because corporations can get better ESG ratings, more loyal customers, and even a lower cost of capital. Now, whether these disclosures are credible or banks just use them as a way to symbolically complying with this new institutional demand is actually a major concern, and it is also the focus of this presentation. In this presentation, we are going to ask if the relationship between banks' environmental disclosures and their lending activities, what is this relationship, and if their environmental disclosures are actually reflected in banks' lending activities. So we use ChatGPT to extract information on whether a bank is discussing the sustainability of its lending policies in its reports. And then we examine the relationship between environmental disclosures and bank lending to firms. Now, as you know, it is quite difficult to capture the brownness of the loan, so we do it in a number of ways. First, we look at brown versus green industries, which allows us to use the entire cross-section of our data. Then we use more precise information on firm-level emission, which applies only to large borrowers, and it's available for a subset of the data we have. And then we find a middle ground and dig deeper into the business descriptions of this firm to see which are greener and which are brown, using the EU taxonomy. Now, in terms of main findings, we document the disconnect between what banks say and what they actually do. And indeed, at the loan level, we find that banks that stress more the environment in their disclosures lend also more to high emission borrowers. And they do so without actually charging higher interest rates or shortening the loan maturity. And when we look at the bank portfolio level, we also find that these banks do not compensate their brown loans by also increasing their exposure to green funds. Now, you could be thinking that there is actually nothing wrong in financing brown firms, because what banks could have been doing is just financing their transition to the green economy. However, this is not what we find. We find no evidence that these loans are funding the transition to green technologies. What instead we find very strong is that banks extend credit to existing brown borrowers, especially if they are financially underperforming. So basically, our assessment is that banks overemphasize their climate goals while continuing their relationship with polluting borrowers. Now, let me give you an overview of the data. Here we use granular long-level data on all Eurozone commercial loans outstandings for Eurozone systemically relevant banks, and this comes from AnaCredit, the European Credit Register. We focus on loan size, interest rate, and maturity, and we focus on the sample of newly issued loans between 2014 and 2020. Then, regarding the classification between green and brown loans, as I mentioned, we use a number of ways to classify the loans. So we start with something simple by using industry-level emissions from Eurostat, which are available at the country, industry, and year level, and we standardize by industry value added. And this allows us to use the entire richness of our dataset. Then we go to firm-level emissions from Gregentem that have the advantage of being very precise. However, they are only cover large firms, so only a subset of our borrowers. And finally, we use business descriptions from Capital IQ and run text analysis on these business descriptions to classify brown and green activities. And this is because we are aware of the fact that even in brown industries, there could be borrowers which are more green or less brown. So we really dig deeper into the business classifications, and this allows us to cover 150,000 borrowers. And finally, we use more standard data, such as firm and bank balance sheet. Now, regarding the construction of our environmental disclosure proxy, let me tell you, if we had to run this project in the US, we would just go to Edgar and download all the information at once. In Europe, there is no such a thing. So we collect and process 1,400 documents approximately, and half of these documents are annual reports, and the remaining part is sustainability, integrated reports, and ad hoc bank communication. And then we use large language models to evaluate bank disclosures. So we collect the documents, we partition them in paragraphs, and then for each document, for each paragraph of each document, we ask ChatGPT the following prompt. Pretend you are an investor. The following text is an excerpt from a bank annual report, and here is where we place the paragraph. Based on this text only, please answer the following question. Are the bank's lending policies environmental sustainable? And there are 3 options, yes, no, or unknown, if the text contains relevant information. Then we build our proxy by using the number of words in the yes paragraph, so the paragraph in which banks disclose the sustainability of their bank lending policy. They say that their lending policies are sustainable, over the total number of words in the bank reports. Then we aggregate this at the bank year level. And however, let me tell you that in previous versions, we also build this measure using dictionaries and other approaches, and but the results are very consistent. So here I'm showing you the evolution of the disclosures in the aggregate. This is how it evolves over time. And as expected, the banks discuss more and more the sustainability of their lending policies. And now the main question is if bank disclosures are actually also reflected in their lending behavior. Before looking to lending outcomes, here in this table we show the relation between environmental disclosures and bank characteristics. And this in order to understand which banks put more emphasis on the sustainability of their lending policies. So as you can see, more extensive environmental disclosures are associated with better environmental ratings provided by external agencies. And I mean, we know from the literature that environmental disclosures enhance bank reputation for, corporate reputation for environmental disclosures, and this also applies to banks. And so one could think that this is also what creates incentives for banks to keep disclosing more and more. On the positive side, what we find is that banks that disclose more tend also to, these are also associated to banks' initiatives to improve their environmental impact. In fact, banks that disclose more tend to are more likely to adopt sustainability reporting standards, to commit to climate-related initiatives, and also actually to participate in the issuance of green bonds. Now, on this chart, what we do is we link our environmental disclosure information with the loan level, with the bank loans data. And what we find is that banks that disclose more are those that actually were more prone to extend loans to brown industries in the past. And this is fine because industries with a larger share of brown loans in their portfolio are those who are subject to greater pressure to improve the greenness of their lending. And the main question is if going forward they actually do so, if their portfolio becomes greener consistently with the volume of their disclosures. And so let me tell you about our main specification. Here we start with loan level regulations, and where the loan amount is the log amount of newly issued credit to a given firm in a given industry and in a given country by a given bank. Now, the coefficient of interest for us is the beta 1, which is highlighted here in orange, I guess. And it refers to the interaction between how brown the loan is and how environmental reporting the bank is. And in the first results, actually, in the results that we saw in this presentation, what we use is we start with the industry measure. So brown in this case takes the value of 1 if the ratio of carbon emission to gross value added of the industry in this given country ranks in the top quintile. And for the high environmental reporter, it also takes the value of 1 if the bank's environmental disclosures rank in the top quintile in this given year. Then, of course, we need to control for demand, and we do this in 2 ways. We either use industry country time fixed effects, or we use firm time fixed effect. And here the idea is that I'm a brown borrower who borrows from 2 banks, one of which talks more about the environment and the other doesn't. And we also control for bank characteristics, standard bank characteristics. Now, what is the hypothesis? If banks with more extensive environmental disclosures engage in greener lending practice, we would expect the coefficient to be negative. If they don't, just do greenwashing, the coefficient should be 0. Now, what do we actually find? What you can see in this table, the coefficient associated to the interaction term is actually positive. And so banks' environmental disclosures are not actually reflected in the lending to brown industries. So, this is consistent across specifications with different set of fixed effects. And when we go to our most conservative estimates, the one that has firm time fixed effects and bank time fixed effects, so what we find is that high environmental reporters actually extend 3.3% more credit to firms in brown industries compared to other banks. And let me show you also how these effects evolves over time. So as you can see, what you find is that the effects is stronger after the Paris Agreement when pressure for it, which is related to the fact that pressure for environmental stewardship increased. So, and we also see this increase in the volume of disclosures. However, we see that there is an even stronger disconnect between what banks say and what they actually do. Next, we look at new relationships. And in this case, what we find is that there is some evidence that high environmental reporters try to reduce new lending exposure to brown borrowers. At least in one specification, we get this. However, when we then aggregate the results at the bank portfolio level, we still find that high environmental reporting banks overall extend more credit to brown industries. So their portfolio remains skewed towards the brown borrowers. And so overall, these environmental statements do not seem to reflect their lending strategies across brown and green sectors. We run a number of robustness and additional results. We also confirm that there is no increase in loans to green industries. We show the effects on maturity and interest rates. Then we, as I mentioned, we use also different ways of measuring the high versus low emission borrowers and do some time slicing of the data. So in the remaining couple of minutes, let me tell you about the channels, why banks that disclose more actually do not engage in greener lending. So one thing that it's obvious to test is if these brown borrowers actually are banks are just financing their transition to greener technologies. So the way we do this is first by looking at if brown firms that get these loans actually reduce their emission intensity over time, and we find that this is not the case. So when we look at the next 3 years after receiving the loan, we don't find that they decrease their emission intensity. One could argue, okay, this is perhaps too short time period to assess this. So our approach is to complement this with alternative ways to validate the channel. So basically, what we do is we look at if banks that disclose more actually lend to brown borrowers, which are more likely to switch to greener technologies. One way to do this is to look at firm investment and R&D. So because we know that switching to greener technologies require higher investment in R&D, so we test whether high environmental reporters lend more to brown borrowers that invest more and make more R&D than other firms in their industries. And then so as you can see in the first two columns, we find that this is actually not the case. They do not lend more to firms that invest more in R&D or that invest more in general. We also look at if they lend more to brown firms that are younger, because we know that young firms are more likely to innovate and disrupt old technologies, but we do not find anything here. And then we also look at if they lend more to firms that actually commit to climate goals, and actually also in this case we find opposite results. And we also dig deeper into the brown sector and see if the green firms into brown industries actually receive more lending. And there is no evidence that higher environmental reporters are more likely to support transition financing. Now, what instead we find that matters in the data is the bank-firm relationship. So high environmental reporters lend more to brown borrowers if they have extended a larger share of their loans in the past to these borrowers. So banks, in other words, banks are reluctant to discontinue established credit relationship with brown borrowers. And the effects are stronger for loans to small borrowers, which are most opaque, which are the most opaque part of banks' balance sheet. So these are the most opaque bank of the balance sheet. So what this means is that if banks claim that their portfolios are becoming greener, but then they do the opposite in terms of small borrowers, this is something that shareholders and other stakeholders cannot verify, because this can only be seen using credit register data, which is only available to supervisors and central banks. So the market has no way to verify this claim and the type of information that banks spread about their lending policies. In addition, we find that also these effects are strong for brown borrowers that are less healthy. And here we look at leverage and interest coverage ratio. And it seems what the results suggest is that the relationship with low quality brown borrowers is what hinders banks' ability to reduce their environmental impact, because these are the borrowers which would be in distress if banks' relationship were terminated, and could also have obviously repercussions on the bank's balance sheet. Now, when it comes to the cross-sectional difference in terms of bank-specific characteristics, we find that this disconnect between environmental disclosure and lending are most pronounced for banks with low capitalization. And this result is consistent with the literature on zombie lending. So it further validates the idea that banks keep lending to brown borrowers, which are low-quality brown borrowers, and they do even more so when they are lower capitalized. And let me just conclude. So what we find in this study is that banks that stress more the environment in their disclosures actually also lend more to high-emission borrowers. We find no evidence that their loans may be favoring the transition to green technologies. And instead, what we find is that banks extend the credit to existing brown borrowers, especially if they are financially underperforming. So overall, our message is that regulating the content of bank disclosures is actually necessary to increase the informativeness of the disclosure and also limit greenwashing practices. And with this, I conclude.
Thanks a lot, Caterina, for being perfectly on time. Now we move to the second paper that is presented by Hyeyoon, and the title is US Banks Exposure to Climate Transition Risk. Hyeyoon, the floor is now yours.
Thank you. Thank you so much for this opportunity to present another paper. This paper is about US banks' exposure to climate transition risks. This is joint work with João and Lee, and we are all at the New York Fed, so the usual disclaimer applies. So in this paper, we ask this question: how much are banks exposed to a specific climate transition policy? For instance, $50 carbon tax growing 5% annually. So to answer this question, we developed a measure to assess banks' credit portfolio exposure to a specific set of climate transition policies. So some empirical challenges are, first, existing approaches typically rely on backward-looking data, for instance, carbon emissions, and we propose a forward-looking measure that can quantify the effect of specific set of climate transition policies on banks. And second, reduced form approaches typically do not capture the general equilibrium effects. And to this end, we build on estimates from general equilibrium climate models. So our measures are forward-looking, and also they can capture both direct and indirect effects of transition policies. And third, publicly available credit data are typically as of origination, so they may not accurately represent current exposure if the banks originate and then sell out their loan after origination. But we employ a granular data set Y14 that provides current loan level credit exposure information for large major US banks. So here's our approach in brief. So we merge these two data sets. The first side is the general equilibrium climate model estimates. So these climate models ask questions like, how much does each industry's output fall if a carbon tax gets introduced? So in this stylized table, you can see that, for instance, coal industry's output may fall 30%, and renewable energies output can go up 20% under a certain carbon tax policy. Then we are going to have this kind of estimate, and this is just stylized example. And on the right-hand side, we are visualizing Y14 data, where we have information on banks' credit portfolio by industry level. So for each bank, we are going to know the share of lending made to each industry. And by merging these two data sets, we can study banks' exposure to transition risk across time, across banks, and across policies. And we can also investigate how banks manage transition risk. And here are the key findings. First, we find that banks' exposure to transition risk substantially vary across climate models. And the average bank exposure as of 2022 and 2023 as well ranges between -1% and 9.5%. So negative 9.5% means that banks are going to lose 9.5% of their credit portfolio value. And -1% means that banks are actually going to benefit from carbon tax policies. And I'm going to explain why in a few slides. And second, across policies, banks' transition risk exposure is greater under tighter policies. This is not surprising, but we can quantify the effect. So relative to a $25 carbon tax, a $50 carbon tax will increase bank exposure by 1% on average. And third, we also considered a severe scenario considering nonlinearity, and we find that the loan portfolio of the average bank can lose up to 11% more than in the baseline scenario. And lastly, we find some evidence suggesting that banks reduce the quantity and increase the price of loans made to the borrowers, making a lot of loans to highly exposed industries. Okay, so we are using 3 climate models. Here is the overview. So the first model is by Jorgensen. And these models, all of these have estimates of industry level changes in industry level output under a certain set of carbon tax policies, but their assumptions are slightly different. So for instance, the Jorgensen model estimates changes in industry level output from 2015 to 2050 if a range of carbon tax policies are put in place in 2020. And one example is initial carbon tax rate of $50 growing at 5% annually. And the second model is by Golder and Hofstede, and they estimate changes in industry level profits over infinite time horizon. If, again, a range of carbon tax policies are starting in 2017. And the key difference from the first model is that the second model considers renewable sector directly. And the third model is NGFS G-cubed model. And they estimate changes in industry level output from 2020 to 2050. And their scenarios are slightly different. They are in terms of current, orderly, and disorderly transitions. So we are going to use these model estimates for each policy. And here is one example from the estimate from the first model by Jorgensen. And each column is for each policy. So the first column is $25 tax growing at 1% annually. And if you look at the fourth row, which is highlighted, the coal mining industry will have 16.3% fall in their output if the $25 tax growing at 1% annually is introduced. And we are going to have this type of table for each model, for each policy, and we are going to merge this with Y14 data. Okay, so this is how we construct exposure measure. So the question is, what proportion of banks' loan portfolio value would be lost if a policy P gets implemented? So this is simply a weighted average of markdown of each industry, where the weight is the proportion of loans made to that industry. So the markdown is coming from this table. So if we go back to this stylized example, if the bank is holding half of its portfolio in coal and half in renewable, and if the coal industry is going to fall by 30%, if renewable is going to go up by 20%, then our exposure measure is going to be simply negative 5%, which is the average of 30 and plus 20. So that's how we are constructing this baseline measure. And here we are making 2 important assumptions. The first assumption is that banks are going to lose the value of loans proportionally to the drop in the output or profit of the borrower's industry. And we're going to relax this assumption in the next slide. And the second important assumption is the static balance sheet assumption. We assume that banks are going to maintain their allocation of loans across industries over time. We acknowledge that this can be a strong assumption, but this is a starting point. So here's the average exposure over time. On the left-hand side, what you're seeing is based on the Jorgensen model, the first model. And on the right-hand side is based on the NGFS model. And you can see that the exposure estimates vary substantially. The maximum average exposure is less than 4% based on the Jorgensen model. But on the right-hand side, it is 13% based on the NGFS model. So let's now look into different policies within Jorgensen model. You can see there are 4 lines, and the bottom line is the least stringent policy, which is $25 tax growing at 1% annually. And you can see that as the policy gets tighter, the exposure is going to go up. And the difference between $25 tax and $50 tax is about 1%. And on the right-hand side is based on the NGFS model. Based on the current policy, the exposure is quite low. It's only around 3%. But under orderly or disorderly transition scenarios, the exposures are much larger. It can go up to almost 11% in 2023. And you can also notice that across these models, across these policies, the exposures seem to be declining at a very slow pace. Okay, so now we are going to consider more severe scenario, considering potential nonlinear effects. So what if banks are more severely affected by the riskiest industries? So we categorize the riskiest industries based on the tables earlier, and we this kind of table, and we define the riskiest industries as the top decile or top two decile exposed industries. And for those industries, we assume that their banks, their loan value will go to 0, which is obviously a severe scenario. And for the rest of industries, we assume, like the earlier, the baseline measure, we assume that the banks are going to lose the value of loans proportionally to the decline in output or profit. And based on this measure, the exposures go up substantially. Based on Jorgensen model on the left-hand side, the green line, the bottom line, is the earlier baseline estimate, and the blue line is when we assume that the top decile industries are going to go bankrupt, and that's about additional 6% compared to the baseline. And the red line on the top is even more severe scenario where the top 2 decile industries are going to go bankrupt, and that's additional 6%. So compared to the baseline, in the most severe scenario that we are considering, the exposure goes up by about 11%. And based on the NGFS model, this average exposure under stress remains similar to the earlier baseline, and this is because NGFS scenarios are already very severe. Okay, next, now we are going to relax the first assumption here. And Y14 data has loan level loss given default and probability of default. So we first compute loan losses from each loan by multiplying the LGD and PD. And then for each industry, we exploit loan level empirical relationship between loan losses and sales to obtain expected losses. And earlier, we were assuming that alpha is 0 and beta is 1, so the drop in the portfolio value is going to be proportional to the decline in output or profit. But here, we are going to use the empirical values from this estimation, and it turns out that the beta is much less than 1. So if we take these into account, then the average portfolio exposure goes down by a lot. So the red line is after adjusting for the loan loss given default and probability of default, and you can see that the average exposure is only about 1%. And on the right-hand side, also based on the NGFS model, after adjusting for the LGD and PD, you can see that the exposure is only about 2% in 2023. And in the last part of our paper, we investigate this question: have banks adjusted lending to risky borrowers? So this is similar to the approaches we've seen in the papers yesterday. Here on the left-hand side, based on the Jorgensen model, we classify loans into 3 categories: high exposure loans, medium exposure loans, and low exposure loans. And the vertical line is Paris Agreement in 2015. And you can see that after the Paris Agreement, banks increased their proportion of loans made to low exposure, and they reduce their loan exposure to high exposure loans. And on the right-hand side, the classification of loans were based on the NGFS model, and the message is the same. We find that banks have moved credit exposure from the riskiest to the least risky industries. And we tested this idea by running definitive style regression, where the outcome variable is the proportion of lending made to the riskiest industries based on different models. And on the right-hand side, we regress the outcome on the full interaction of post and exposure variable. The post is the dummy, which takes value of 1 if it was after the Paris Agreement. And the exposure is the exposure under stress, the quarter before Paris Agreement. And we have bank level controls and also bank and quarter fixed effects. And we expect this beta 1 to be negative if the banks are moving their loans from riskiest to the least risky industries. And that's what we are seeing here for some models, for some policies. So each column is for a different policy. And we can see that the first and third and fourth columns are negative and significant. However, for some models, we don't find evidence. And this was about the quantity. And in the next slide, this is about the pricing. So left-hand side variable is yield spread, and the beta 2 is positive for some specification. If we look at the column 2, we find that the banks are charging 20 basis points higher after Paris Agreement if the bank was high exposure bank compared to the low exposure bank. And we also investigated the bank-borrower relationship after the signing of Net Zero Banking Alliance. So on the left-hand side, again, this is based on the Jorgensen model, and what you're seeing is the relationship between either signatory or non-signatory banks with the brown or her green industry. And you can see that for brown industry on the left-hand side, the 2 bars, you can see that they were more likely to switch to non-signatory banks. And on the right panel, within the left plot, you can see that green borrowers became more likely to switch to signatory banks. These are the odds ratio of switch to non-signatory from signatory. And so we see that some evidence of change in relationship after bank signing of Net Zero Alliance. And lastly, you might have been wondering how our exposure is different from the common measure, which is carbon emissions. And to answer this question, we regressed our exposure measure on the bank level emission. And these numbers are the R squared from the regression for different models for different rows and different policy for different columns. And if you look at the first column, first row, the R squared is about 57%. So it indicates that important part of the variation, about 40%, is not driven by emissions. And we think that this is coming from the nature of forward-looking nature of our exposure measure. So to conclude, in this paper, we developed a new measure of US banks' exposure to transition risk, building upon general equilibrium model estimates. And we find that the estimated exposures are generally modest under the baseline model and also the realistic model, a realistic assumption considering the loan law, the LGD and PD. And in a very severe scenario, we find that the exposures are no higher than 16%. And we find some evidence that banks' exposure to the riskiest industries are falling over time. And we find some evidence that banks are reducing their loan size and increasing their pricing, of the loans made to the most risky industries. And this concludes my presentation, and I look forward to discussion and comments. Thank you.
Thanks a lot, Hyeyoon. Now we'll move to the third paper presented by Miguel, and the title is Climate Risk, Bank Lending and Monetary Policy. Miguel, the floor is all yours.
Thank you. And let me start by thanking also the organizer for the opportunity to be here. I think it's a really nice program because not only it's of course focused to the topic, but I think there's a great complementarity between the papers. Now, what we saw yesterday on the link between climate risk and general risk, and today more on the bank policies, and hopefully I will give some more insights on that. Now, this is joint work with some colleagues. Carlo is a colleague at the European Central Bank, and then Marco Pagano and Andrea Polo. And we have the usual disclaimer. No, some of us are from the central bank, but these are of course our own private opinions. So let me start directly with our research questions. So we have two main questions. The first one is on whether banks price climate risk explicitly. You know, do they react in their lending policies to climate risk specifically, you know, separately from other types of risk? Now, within this question, we are also going to investigate whether beyond thinking about the firm's current climate risk, the banks take into account their more forward-looking plans to adjust their activity, and then we are going to look also at different types of banks and whether banks themselves show a stronger commitment, and that matters. Then our second main question is on whether there is an interaction between this and monetary policy. And here we see this as really an empirical question, because ex ante we see that there are two possible channels at work, and it's hard to distinguish based on theory which one would dominate. No, because on the one hand we have this kind of financial frictions channel, no, where basically we know that low emission firms tend to have, for instance, lower collateral. Potentially, they are younger, they have less tangible assets, and this might mean that monetary tightening discourages lending to these firms. On the other hand, there is here something more related to a risk-taking channel, you know, through which banks could, like we saw yesterday, think of climate risk as another new type of risk, and therefore activate kind of a specific version of the standard risk-taking channel, but related to risk. And in this case, of course, then in case of a monetary policy tightening, banks would tighten more to the more climate risky firms. A preview of the findings, so a bit of a spoiler. What do we find? The answer that we find is yes to both questions. So we are going to find that banks charge higher interest rates to firms that have higher carbon emissions. We are also going to find that they charge lower rates to firms that commit to lower emissions, and that both effects are larger for banks that are also committed to decarbonization. Regarding the impact of monetary policy, and linking to the two channels that I presented before, we are going to find that this climate risk-taking channel of monetary policy will dominate. So basically, when there is a tightening, banks will not only increase the credit risk premium, but also the carbon emission premium. So they'll penalize relatively more the more polluting firms, and this relative is important, because the results that I will show you are going to be based on loan level data. We are essentially going to use cross-sectional variation for identification, and this of course means that all results are relative. So this is a comparative statement. We are of course not saying that the monetary policy tightening in general supports, let's say, the green lending or decarbonization of the economy, because of course when you have a tightening of monetary policy, the cost of credit is higher, and we need credit to for this transition. Also, the only thing we are saying is that in relative terms, then the green firms are not more penalized than the others. So that said, let me start going into the outline. I will not go deeply or much at all into the literature, also because a lot of it, the papers that I'm citing either were presented here or the authors are here. So it's not very efficient that I'll spend time on that. I will just say maybe that you know, there is of course much more in terms of let's say credit behavior. There is much more evidence in security in credit markets than in loan markets, like we have in this section, and that as far as we know, there is not no evidence at all on the link between this and monetary policy. This I will also skip, so it's just a bit more detail on these two channels, so that we don't delay also our break later. And let me briefly speak about then the data that we use. So we use the Anacredit data set, so the credit registry for all the euro area countries. This means we have monthly data from late 2018 to the end of 2022. Of course, we have a lot of detailed information at the loan firm and bank level. The main aspects that we are going to be focusing on are the interest rate that the bank charges, sorry. Of course, the amount of the loan, and the risk that, or say the classic credit risk that the banks attribute to the loan. And here our main proxy is going to be the probability of default that is used for the internal rating-based models estimated by the banks, which we'll also we'll discuss. That might also matter, because this measure of risk is the one that matters also for the capital requirements of the banks. Then we are going to on the firm side, we are going to focus on listed firms, and this is because these are firms for which we have more evidence available on their climate risk. So we're going to use CO2 emissions that are reported directly by the firms, then with some quality and plausibility checks that the data provider does. And we are going to look also from the Refinitiv Icon data set at the variable that measures the commitment that the firm has to reduce firm emissions. So again, as postulated by people that are here in the room, no? Santa Carbone and Patrick Bolton. So just to say the reason why we like this firm commitment variable is that it gives us more of a forward-looking view. No, not only the past emissions but also the plans of the firms, and you know, and they both find in their studies that these carbon emissions are actually now eventually related to future emissions. So they are a good proxy for this forward-looking idea. Then this I skip, but one important point also is then spend 1 minute on the monetary policy measure. Our main measure here is going to be from high frequency surprises, now that take basically kind of an event study methodology to measure the, you know, the surprise change in market pricing due to the announcement, so that we are sure that we can actually identify the monetary policy and not other conflated effects. So this is just the descriptive statistics of our variables. We can skip this just to remind what the main variables are that we are going to be working with, and let's go to our results. Starting, before I show you tables with a lot of numbers, just with a couple of purely descriptive charts that hopefully illustrate the result I will show you later, but here purely based on data. Now, this is unconditional. We just plot data splitting by two groups. And what we see here is that when we look at interest rates through our sample period, even in this unconditional way, we see that. So here the green firms are the green ones on the left. We have them based on the carbon emissions. We see that firms with low carbon emissions tend to get lower interest rates. And on the right, we see also that firms that announce targets to reduce the emissions, they also tend to get lower rates in the data again. Moving then to the analysis, where we use, of course, also a lot of fixed effects for identification, and this is what the different columns do. No, so we go from controlling at the industry location and sector, so that we can keep the whole sample, to controlling also directly at the firm level on the right. And but the main results that you see, let me just walk you through them. So first result is on the probability of default. So positive coefficient here is of course not at all surprising, just a sanity check. No, we see that banks that have banks charge a higher interest rate to firms that are riskier. So good, we would expect that. Then on the second line, we measure instead the carbon emissions of the firms, and here, more interestingly, we find also a positive coefficient. No, so even when it's not just because of let's say some coincidence in the different association between different types of firms, but even controlling for the credit risk of the firms, if a firm has higher emissions, the bank will charge them a higher rate. But they will tend to charge a lower rate if the firm has announced a target to reduce these emissions. And then what is also interesting is this interaction variable that tells us that actually this announcement of the target is more valuable for firms that actually pollute a lot, which is also, I guess, intuitive. No, it's more useful for you to commit to reduce your emissions if you do have high emissions. Otherwise, it's not that it would make a very big difference. Then let me spend a couple of words on our control for risk, because this is of course crucial, right? Because otherwise it could be that we are not isolating well the different types of risk. So it could be that banks already incorporate in their probability of default the climate risk considerations. Now, we do not think that is the case. Why is that? Well, first of all, I guess the most important point is they have no incentive to do that, right? Because these probabilities of default, like I said in the beginning, matter for the computation of their risk weights. So it would be very strange that the bank would voluntarily include another source of risk that would make it need to put aside more capital if they are not forced to it. Second, there are different horizons, right? So these probabilities of default are measured over a 1-year horizon. And of course, climate risk, even though here we have transition risk, it would in any case probably have a bit of a longer horizon. And also, as we know and we saw yesterday, it's not trivial. It's difficult to do this, to include this in models. Now, we also do some empirical checks, and we see that actually the two variables are not really correlated at all. And also, we have some robustness where instead of controlling for this PD, we add kind of a firm balance sheet observables to the same effect, and results are robust to that. Then the second exercise that I have here is to show that also the commitment of the bank seems to matter for the pricing. So banks that are committed to decarbonization essentially accentuate the results that we saw before. And finally, the result that answers then our second and newer question, the one on monetary policy. Here, let's first focus on the first column. So again, this is a bit of a sanity check for our results. You will see that we in this column we have fewer controls. No, we don't have a lot of yeses on the fixed effects. Crucially, we don't have time fixed effects. That's why we can identify the coefficient of the monetary policy, and we see a positive one. So this is really not a new result that we give. It's just a standard risk-taking channel results, right? If you have a monetary policy tightening, you have an increase in interest rates, and you have a stronger increase for riskier borrowers. So just to show that, you know, we corroborate the standard risk-taking channel. Then more interestingly, when we go to the other columns, we have more control. So we lose this individual monetary policy coefficient, but we gain this interaction with the climate variables. And what we see again is that we have the same sign for carbon emissions as we have for PD. So it seems that just like banks have a risk-taking channel for credit risk, the same channel seems to be active for climate risk. So when there is a monetary policy tightening, they tend to increase rates relatively more to the firms that are polluting more, but they do it less for the firms that are committing to pollute less in the future. So that the firms that are seen to be from less climate risky from a more forward-looking perspective. Now, all the results that I showed you until now were based on prices, and for identification, they were also based on relatively short lags, no? Because of course, over a long period, other things can happen. But we also know that monetary policy does not work immediately, right? There are lags in how monetary policy is transmitted, and these lags tend to be longer for volumes than they are for prices, right? Because banks can adjust their prices relatively quickly, but then, you know, to adjust properly the lending policy, and also for the borrowers and the firms to adjust their lending plans, this can take longer. So the reaction of volumes tends to take longer. So what we do is we do also kind of a local projection exercise so that we can look at volumes over a longer horizon. We start by doing this also for the prices, just for consistency with what we showed you before. The results are basically the same that we saw before. Now you see that when you have the monetary policy tightening, you will have over time an increase in prices. Interestingly, you see that for the interaction with the emissions of the firms, the weighting doesn't matter a lot, so the reaction tend to be quick. Instead, for the target, you need a bit more months, but in general, for the pricing, reactions are relatively quick. Instead, when we look at volumes, you see that you need to go further to the right in these charts to start to see effects, right? At T, basically you have these box plots with the standard errors intersecting 0, but then if you wait 1 year, you start to see significant effects. You see that when you have a tightening, you have less loan volumes in general on the left-hand side. You see that the loan volumes decrease more for the high emission firms in the middle, and then that this is mitigated for the firms that announce their targets on the right-hand side. Again, eventually, you know, after some time. Now these monetary policy surprises are quite attractive because they give very good identification. Or by going in the high frequency, they ensure that we are looking at monetary policy, not at other effects that can happen at the same time. Of course, by controlling so much, you get only a part of the effect, because you cannot be sure that you really have all the events in your methodology. You know, so here a robustness check that we have is kind of a very simple diff in diff strategy, because we know kind of what are in our sample the most important dates of big monetary policy action, and we split the data based on those. No, so we have, of course, December 21, no, when the ECB announced the end of purchases and kind of hinted at the start of tightening, and then we have July 22 when there was actually the first rate hike. Sorry. We can split the data based on these dates and get essentially results that are consistent with the ones I showed you for the surprises. And just to finalize, I would like to show you just some again descriptive data This one is rather than hard data is based on the bank lending survey, because in July last year there was a question that was introduced in this survey that is exactly linked to banks' lending policies. And interestingly, the results of the replies of the banks were quite consistent with what we find in the data. And also in the first chart on the left-hand side, you see that banks reported that they tend to tighten relatively more their credit standards and their terms and conditions to firms that are brown, relatively east to firms that are green, with the firms in transition there in the middle. And then on the right hand side, we go a further step. We look at the individual replies of the banks, and we split them into banks committed and uncommitted. And here, results are less clear cut, but still you see that, for instance, when you look at credit standards, the blue bar is clearly below the orange for the green firms. And with this, I conclude, just reminding the main results of the paper. No, we find that euro area banks charge higher rates to firms with higher emissions and lower to firms that commit to the green transition. We find that the bank's commitment matters for this. We find then that the risk-taking channel, this climate risk-taking channel of monetary policy, So contractionary shocks lead to higher premia and lower volume for high emission firms, less so for firms committed to decarbonization. And so before I stop again, to remind this point on relative effects, that is quite important. So this is impact of monetary policy on green firms compared to the other firms, not in general. With this, I conclude. Thank you.
Thanks a lot, Miguel. Now we'll move to the discussion. Roberta, the floor is now yours.
Thank you very much. Good morning, everyone. I would like first to thank the organizing of this conference for inviting me to discuss these very interesting papers. And I enjoyed very much their readings, and I found them very insightful. Before I start the presentation, of course, the usual disclaimer applies. The opinions expressed here are mine and do not reflect those of the Banca d'Italia. This is the outline of the presentations. In the first 5 minutes, I'll try to quickly recall what the paper do, how do they do it. I don't know, it's something the mechanics of the presentation, the PowerPoint presentations. But anyway, in the first 5 minutes, I will quickly recall what the paper do, how do they do it, and what's the paper found. While in the second part of the presentation, in the rest of 10 minutes, I will try to make some considerations on the main highlights of the paper, and then I will conclude. So let's start on what the paper do. Actually, the paper all focus on transition risk and disregard physical risk, and focus on banks' lending behavior and loan portfolio, because of course they are more opaque than security portfolio. And then all answer basically the same questions. Have banks started to adjust their lending policies to account for climate-related financial risks? This is the first question. The second question is there any differences between banks that have committed to net zero carbon emission with respect to those that do not commit? The first paper from Miguel also asked whether the traditional risk-taking channel of monetary policies can be extended to climate-related financial risk, while the paper from Hyeyoon also, while answering to this question, is also asking how much the the exposure of US banks is to transition risk. This is actually the sequencing I'm going to use in the presentation for the sake of comparison. So I will start by describing the paper by Miguel, and then I will continue with the paper by Caterina Mendicino, and last but not least, the wonderful paper by Jung. So how do they do it? Here you can find the comparison tables, of course, in the interest of time, and I cannot do into details, but it's actually something that allow me to make some consideration, some comparison among the two. So basically, to summarize, all the paper focus on the loan markets. They also try to go beyond the syndicated loan markets that are usually focused in the literature to encompass also loans granted to small and medium enterprises and use empirical strategies based on panel regressions to investigate banks' behaviors. All paper combine loan level data, balance sheet data, with the climate metrics, a different level of granularities, sectoral vis-a-vis firm level, and differentiate the analysis between high committed banks and less committed banks. The first two papers, so the one by Miguel, the second one by Caterina Mendicino, focus on euro area banks and rely on carbon emission data as a proxy of transition risks, while the paper from the US use forward-looking general equilibrium sensitivities to climate policies to quantify the impact of climate change on banks' risk exposures. Also, the sample periods partially overlaps. So what the paper found. So basically, the paper by Miguel found that controlling for firms' probability of defaults, euro area banks charge higher interest rates to firms with higher carbon emission and lower rate to those that commit to reducing their emission in the future. So green line for them. They also found evidence in their data of a climate risk-taking channel. The paper from Caterina Mendicino found that banks classified as high environmental reporters, so the so-called glossy green banks, grant more credit to brown borrowers, especially when they are small and are financially underperforming. They apply a very novel approach to extrapolate information from more than 1,000 sustainability reports to infer the commitment from banks. So from their perspective, red light on what would be the expectation from policymakers. Last but not least, the Hyeyoon paper found that banks, US banks, large banks, do not appear to have large exposures to transition risks, and banks that are committed and have signed the net zero alliance have started to reduce the lending towards more risky industries and to apply higher interest rates. Now let's make some comments. So I will start from the paper of Miguel. So undoubtedly, the paper makes an important contribution to the existing literature and of course helps all stakeholders to understand the potential for financial institutions and monetary policy to influence the transition. So interestingly, they found that banks differentiate their lending rates not only based on the client's carbon emissions, but more importantly on the future emissions. Even though they, of course, they do not enter into detail on how ambitious the reduction targets of firms are. So it would be interesting to see whether the results are robust, also taking into consideration some more detail on the client's commitment to reduction target. The estimated impact on loan spread is squared quite well with existing literature. I pick up here figures that colleagues would like to show. Thank you very much. Actually, this is a picture for ABIS working paper published at the end of last year in December, containing a literary review. The authors of the paper went through more than 90 papers and covering several strands of literature, either paper focusing on transition risks, like the one in these sessions, or paper focusing on physical risks. Actually, they found that in the literature, 12 papers focused on the impact of climate change on loans spreads and in reaction to a standard increase on banks' climate risk exposures. Prices on loans tend to increase in the range between 25%, of course, with few outliers. And this is true both for physical risk, the blue bar, and both for transition risks. So the second question for Miguel is whether the impact, how do they assess the impact? They found that the increase in loan spreads average around 4 basis points and rise to 7 basis points for heavy emitters. So it would be interesting to know whether they have done some robustness analysis by controlling, for instance, loan size, loan maturities, and firm size, to see how it is placed with respect to this literature. Going back to the slide. Okay. They also found in their database evidence of a climate risk-taking channel that is even less explored in the literature. So they found that monetary tightening constrained lending conditions relatively less for green firms. But actually, the most important question from my side, this is actually the first that came to my mind when I went through the paper, is how can we reconcile these findings with those from Caterina? Because both papers focus on euro area banks. Both papers use the same data sets, actually, unaccredited and carbon emission data, though from different providers. Miguel used Refinitives, I'm not wrong, while Caterina Urgentum. So my question is, it's a matter of a definition. Of course, they use they classified banks between committed and not committed in different way. They also have a slightly different specification because Miguel focused on lending spread while Caterina focused on lending volume. They also cover different sample periods, so, but I was struggling to strive a reason why, but without the data set, it's quite difficult to end up with these questions. So let's go to the paper from Caterina. So of course, Caterina, the paper from Caterina and the other co-authors are the new, I would say also unexpected perspective to the existing literature, because most papers in the literature actually found that green banks tend to reduce lending to brown borrowers instead of increasing. The explanation they gave to these striking results is that committed banks, the one they call green glossy banks, seems prioritizing relationship with existing borrowers, especially when they are financially underperforming with respect to having strategies, the environmental sustainability strategies. And it seems that low capitalized committed banks are more likely to engage in this behavior than the others. So of course, from a supervisory perspective, since my core business at this moment, these results, of course, would have a strong policy implication, either for the quality of disclosures and for the detection of greenwashing risks. What's common level understanding is increasing. So when I would like to mention here that in Banca d'Italia we went through the complex reporting disclosure requirement that banks, European banks are subject to in a paper that we published at the end of 2022. And we made a lot of review of these reported requirements by looking at their complexity, but their coverage, and we end up with the conclusion that actually for banks, the main challenge is to access quality data from their counterparties, especially when they are small, medium enterprises. So the questions for Caterina is whether they have considered these challenges when, from banks, and whether they can be make some controls for this in the analysis, just to see whether the evidence is still continue to be robust. But again, also for Caterina, the question is how can we reconcile these findings? An explanation can be found in the literature. The paper from Dalis et al. Published in 2023, for instance, found that higher loan spread could be associated with higher demand for loans by brown firms that have lost access to capital markets, and this greater demand from brown firms could be also associated by large borrowing. Last but not least, the paper from Hyeyoon has the merit to acknowledge the limitation of carbon emission data to adequately measure banks' climate risk exposures. Actually, we are struggling with the same issue. When we have run an in-depth assessment of data needs and data gap for Italy in a paper we published in 2022, and we end up with the conclusion that maybe granular data on energy consumption for both firms and households could be a simpler and cost-effective alternatives to carbon emission data. But of course, if there are the challenges to access this kind of data, how it seems to be the case also in Italy, we can now strive to increase the signaling power of carbon emission data. And one possibility is to build an attribution framework just to understand what are the driving behind carbon emission data. As a reaction to this, they found that carbon emission data are able to explain just 60% of US banks' exposure to transition risk, and instead propose a novel approach based on general equilibrium models. While general equilibrium models take into consideration some endogeneity, like the one also recommended by the keynote speaker yesterday, these are not free from problems, from limitations. They rely on simplified assumptions. They anyway apply static approach, and they are aggregate at sectoral level. They are based on scenarios that are far from being perfect. So as a consequence, the magnitude of the impact could be underestimated in some important dimension. And this is actually the conclusion that the paper I mentioned before from the EIEF draw at the end of the literature review of these 90 papers. Let me conclude. So climate policy are multidimensional, as we mentioned also yesterday. They involve a number of policy dimensions related to broader political economy and regulatory landscape that are very difficult to control for in the analysis. These three papers offer useful insights on lending behavior, which is relatively more opaque and less explored than securities, for instance, market behavior. And apart from few outliers overall, all the literature, not only for the paper from the authors, but in general, the empirical literature point to a relatively small impact of climate change on banks' loan portfolio. And the question for supervisors and policymakers is if this is the case or whether this is mispriced by banks. That would make the issue much more of concern for us. And the answer is, of course, there are still analytical, we have made a lot of progress, and I think the paper of the conference contribute a lot to this, but there are still analytical issues to tackle related to granularity of data, data coverage, and also methodological issues that prevent us for a definite assessment of risk. Thank you very much.
Thanks a lot, Roberta, for your insightful comments. We have time for a couple of questions from the public, and then the speakers can reply.
Just a quick question to Hyeyoon. So credit following some key dates, the Paris Agreement, and the other one is about commitment by banks to environmental cause. Bank credit to ground firms in the US seem to go down. I remember one of a couple of your charts. So the question is whether private credit should be the answer to this. That is, since I'm afraid these brown sectors are not really shrinking, the picture could point out to a phenomenon such as transition risk maybe going down in banks' balance sheet budget, but moving elsewhere in the system with no net effect. And I was wondering whether you have considered this possibility.
Thank you. Thank you for the presentation. Those were great papers. I have a question for Miguel, actually, too. One, so I left the day yesterday convinced that we finally will find a link between ESG as some proxy for climate risk and creditworthiness. And then you showed me today that maybe I did not understand yesterday, or maybe I was wrong yesterday, in the sense that you seem to find a link despite controlling for credit risk. And so I'm trying to understand, is that because ESG essentially is an imperfect proxy for credit risk, so there's something else that is not captured there? Or what is the channel you have in mind there in some sense, right? Is it something that is not really credit, it's like reputational risk, it's because the time horizon of loans is very different from how people think about credit risk. So how do you reconcile that? Can we reconcile what I thought we learned yesterday with this? The second one is on quantities. The numbers that you show both for the impact, even after you control for credit risk, is, if I remember, between 3 and 10 basis points. And then the monetary policy part also was like 1 to 5 basis points. I'm afraid that those numbers are not large enough, I think, to affect behavior in some sense, right? So if I'm charged 5 basis points more, so what? How should I think about that? Do you think that, should we expect those numbers to be bigger, essentially? Are they still not pricing credit risk the proper way, even if they're directionally going in the right direction?
In the interest of time now, the speakers can reply. And if you have any other question, maybe you can talk during the break. Thanks.
Okay, thank you for your question. I fully agree that about your concern that the risk of financial intermediaries are moving banks, risk moving from banks to non-banks. That's definitely a concern. But we don't have data set for NBFIs, non-bank financial intermediaries. So we were not able to do anything there in this paper, but I agree that it's a very important question to consider. And just a reply to Roberta, thank you so much for your discussion. It would be interesting to look into energy consumption and see how it relates to our measure. And also NGFS scenarios, of course, it's far from perfect, but it is one of the most popular scenarios that are considered by most central banks. That's why we are considering those. And the underestimation, again, we agree. And in case there is feedback effect, of course, there's going to be underestimated part of the underestimated part. So thank you very much.
Caterina, you want to reply?
Yeah, so thank you very much for the opportunity to clarify this. So let me say, first of all, our paper is not about commitment, but it's about voluntary disclosures. And I would actually, to go back to Roberta's point, I would actually not underestimate the information that banks have about their borrowers, especially when it comes to borrowers to which they extend a larger share of loans. So they have at least the same type of information we know, and they are at least able to understand if these are the brown firms which are more likely to transition to the green technologies or not. So that could be looking at the R&D, at their age, if they have committed or not, at their business descriptions. I'm sure there is something banks could do in that direction. They know very well, actually, their business better than us, I guess, which just look at the data. But in terms of our results, I want to emphasize that our results are more prevalent for small firms. And this is where banks can hide more, although this is still remains the bread and butter of their business. For what concerns more visible activities that can be syndicated loans or larger firms or securities, what the literature has shown is perfectly in line with some of the fundings we've also seen today, that banks engage more in the greening of this type of investment. And this is consistent with the fact that this is what actually shareholders and the stakeholders more in general can also have, and this is what can also affect their market valuation and ESG ratings. On the contrary, lending to small firms, to small brown firms, is very hardly verifiable by the market. And we are able to uncover this because thanks to really to the granularity of the Anacredit data. So overall, what we argue is that banks, by disclosing about their lending policies, have the tendency to create a poor information environment for shareholders to value their environmental actions. And this points to an emerging challenge for supervisors and regulators, actually. So, but I would be happy to discuss more about this and other questions. So I'm not there. We cannot talk in the break, but please feel free to get in touch.
Thanks,
I would love to talk about this.
Thank you. Miguel?
So thank you, first of all, for the nice discussion, but also for the questions from the floor. Let me try to go in order. So on the degree of commitment, I think it just highlights also what we were discussing yesterday in terms of difficulty of having good data on these topics. No, so we faced here the challenge of balancing the possibility of having something more detailed, but then hard to compare and hard to verify and available for less firms, or having something that is kind of more transparent and comparable, and we opted more for the second. But yeah, we can also have some exercises with the other one to compare. But again, given the difficulty in measurement, our option was to go more for simplicity and transparency. On controlling for loan maturity and size, I didn't go into this too much in the presentation, but we kind of do it implicitly because our dependent variable is actually the spread between the interest rate the bank charges and the maturity matched risk-free rate. So in a way, the maturity is kind of there automatically, and then also we have either fixed effects for the firm or for the size of the firm. So in a way, we capture also the size effect through the firm I did not show you, what I did not show you was the size of the loan itself. That, you know, maybe it's the firm is more important, but there could be also that effect. But this is something that we can show also in alternative robustness specifications. On the link with Caterina's paper, I don't think I need to add much, because I agree with what she said. No, I think there are two big differences. One is on say commitment that I measure and disclosure that she measures. The other one is also on the focus on the size. No, because by looking at the main focus of our paper is on the emissions of the firms. To get information on that, we are a bit restricted to larger firms, and maybe their effect comes more indeed from the smaller ones. Now, more generally, our results, again, important ones in our view, are on the monetary policy, but also on this average effect. You know, beyond discriminating between banks that are committed, banks that are not committed, what we find is that in general, banks do seem to somehow price the credit risk on average, and this is probably what matters for the supervisory perspective. Then, of course, there is the harder question of how much and is it enough, and I'll try to say something on that. But that's, of course, again, admittedly the harder question. So let me tackle first an easier one on the link with yesterday, and whether we say on credit risk is different. I think it's actually very consistent. So basically, what I was trying to say is that climate risk tells you more than what we see in usual measures of credit risk. So in other measures of credit risk that we know that do not consider this. Now, we don't see this from let's say the leverage of the firms. We don't see this from these PDs that go into the capital requirements. Ultimately, I guess all risks boil down to credit risk, right? In the end, if there's an actual risk, what you care is whether the borrower is going to pay. So I think there we are fully consistent. So just one word on, is it enough? Again, hard to tell. I will not give you a convincing answer. I can give you a few numbers. So these premiums that we have, we say that let's say this 4 basis point premium for firms with high emissions and 10 basis point discount for firms that are committed are kind of something between 5 and 15% of the standard deviation. So just to note here that given that these are loans to relatively large firms, you know, small spreads matter because they are the pricing is kind of tight here, and you know, 10 basis points can be a significant amount of money at the end of the day.
Thank you, Miguel. Thanks, everybody. And now we'll finish this session and we reconvene at 11 for the panel.